we can start. People will join as we go on. Yeah. So
you will see. I think you will see I'm setting up your meeting for Facebook Live, Diane, redirecting to Facebook Live page. You're up.
okay. So thank you very much for joining us right now on this first Saturday of the month of October. This month we will be talking more on, yes, still investments, but this month we'll be talking more of detailed investments. And today we are starting with insurance and investments. Like, do we really know what insurance is when it comes, and what investment products that have an insurance element tied into them? Can we differentiate those products? Can we be able to tell if I'm taking an education policy, if the maturity date is in the next 10 years, I cannot withdraw because these are the terms and conditions? Do we read the insurance terms and conditions when it comes to our investments? And is insurance an investment strategy? So today we are joined by a very beautiful woman called Charlene. She is also called Mama Bima Kenya. She is an insurance agent, seasoned insurance agent, and she has a company called Plexis Insurance Agents. So feel free to ask all the questions that you may have. Shoot them from Facebook, shoot them from our Zoom link. We shall address them as they come. Yes, and Charlene, over to you.
Thank you very much, Rose. Morning, everyone. I'm Kenny. We are getting down to business day. I'm very grateful to the Vasili team for inviting me to just share with you, engage you. As Rose has mentioned, my name is Mama Bima Kenya, but my government name, let's start with my story. My government name is Charlene Kimara, but my clients call me Mama Bima. Yes, anytime I pick call, that's the other name I hear on the other end. I'm an insurance agent and a financial advisor. I'm very passionate about doing my part when it comes to financial literacy. I'm the proprietor of an agency called Plexis. And that's why when Rose invited me to come speak with you, engage you, I was very excited because we are in sync. I love to promote financial literacy, just like they do at Vasili. I run a fortnightly live event on my Facebook page. I hope you can actually be joining those sessions also. My page is called Mama Bima Kenya. And basically the conversations that we have on the page are to promote financial health, both of my clients and my followers. And currently we are doing a session on retirement planning, a 4-part series on planning. And this coming Monday, we'll be handling annuities. So I hope you could actually join us and just get to learn. Join us and learn together. All in all, I'm an agent, insurance agent, financial advisor, and I love protecting people through insurance and investment products. So Rose challenged me and she told me, Charlene, I want you to come and talk, talk about which one is more important, insurance vis-a-vis investments. And this is actually a question I encounter a lot from my clients, where in most cases, for example, if they're doing a financial plan for a client, we are probably doing an education policy for their child. And I always encounter a question like, Charlene, what if I put this money, say, in a fixed deposit, or if I purchase a bond, don't you think I would get better returns than taking up an education policy. And to respond to this question, I want us to start with the analogy of the mango versus banana. Two very good fruits here. I'm sure we could probably have a favorite. Very sumptuous, juicy, but can you really compare this mango to the banana? Can you compare an apple to an orange? Is it possible to do a comparison? Both these fruits belong to the fruit. They're both fruits, right? Fruit family, right? But they both have nutritional value, different flavors. So if you combine these fruits, you then get the perfect fruit salad. And one thing that we should actually notice, one fruit can never make a fruit salad. But when you combine now your mango, you combine your banana, you put in some strawberries, put in some pineapple, then you get the perfect fruit salad. And that is the same, that's the same concept when we are doing a financial plan. Insurance versus investments. Which one is more important? And I say both are equally important, because insurance and investments can never really be compared. These two they give you as a client very different opportunities, and they serve different objectives. Now, your insurance, it is mainly for protection purposes. And this is something I always clarify with clients. When we taking up an insurance product, key benefit is protection. Okay, so for insurance, you're mainly talking of protection, securing your future. For investments, we are thinking, if I lock in my money in this fixed deposit, it could be, say, a wealth management fund. My rate of return is 9%. By the end of the day, I will have gotten X amount of interest. So two insurance and investments are very different. They serve different objectives, but at the end of the day, when you mix them properly in your financial plan, then you get the perfect start. And through the previous webinars that have been held here in Vasili, it's clear that we are in agreement that when you're working out your financial plan, when you're drawing out your financial plan, investments, we do not have a question about having an investment portfolio. So would Mputhia take us through how to invest in equities market in Kenya. Gitau told us about investment opportunities for chairmans. So we are in agreement. We've already dealt with balance funds, equity funds. So we are in agreement that mutual funds, stocks, money market, these are important. So today, I will actually make a case for having insurance in your portfolio. Why it's important to actually have that protection portfolio in your financial plan. So to get started, we ask, why insurance? So insurance was created to protect the things you love. Insurance protects you against an unforeseen financial loss, or if the person who has actually caused you this harm is a third party, insurance now comes in. So you require insurance to protect yourself against low probability events, but with high impact. What I mean by that is low probability is, for example, for your motor vehicle, the probability that you will probably have an accident and your vehicle becomes a write-off is low. But what is the impact of that accident? The write-off actually leave you really dented, right? Say if you had a third party. If you had third-party insurance, it would leave you very dented because you have to dip into your pocket to purchase another vehicle, or you are unable to actually do that. Now with insurance, you transfer that risk to the insurance company. But you pay, let's say, even a vehicle valued at about 3 million. Yes, 3 million shillings. You get a comprehensive rate, maybe at 3.75, then add 0.25% of excess protectors. You get the vehicle at about 4%. So at 3 million, maybe you're paying about 120,000 plus some taxes. But that 120,000, should your vehicle become a write-off, the insurance company will actually honor the contract and pay you the 3 million shillings. So yes, it's a low probability event. The probability of you having an accident and your vehicle being written off is low, but the impact would be high should that happen. Why insurance still? So why insurance? Because we need safety and protection in advance. So it's actually smart to have insurance in your portfolio. You want to be fully prepared to deal with contingents in life so that when unexpected events happen, you have actually planned yourself ahead. We also purchase insurance because we want to secure our future goals. I'm a mom of a 2-year-old, and I have tax. I keep taking up every time. I am able to increase my income. I find myself picking up a few education plans here and there, and the reason actually for doing this, other than because it commits me, it's a savings that I have to be very committed to in the long run. But I always stay, with the assurance that should I not be there tomorrow, my baby Daniela will actually study. She will, the vision I have for her school. I know that by the time she gets into junior secondary, the education plan will actually start paying the annual bonuses payments. That is the annual school fees. So we actually purchase insurance to secure our future goals. We also purchase insurance for peace of mind. Say you have a wines and spirits, for example. This I had the opportunity to insure a wines and spirits just here along Kindaruma Road, and the stock value, the value of the stock was approximately, 1 million shillings, and the quote was about 18,000 shillings. So in a year, that customer only pays 18,000 shillings for a cover of 1 million shillings. So he gets to sleep stress-free. Should the worst happen, should fire raise down, the building where his shop is located, should the wines and spirits be burglarized, he can sleep stress-free knowing that the business is protected. So yes, we purchase insurance because we need that peace of mind. Number 4, next, insurance encourages savings. See, in the long run, every time you put aside, it could be, say, that education plan that you are saving for. Every time you put aside the monthly premiums, it helps to reduce your expenses in the long run. You actually become very intentional in how you use your money. And at the same time, for example, let's talk about health insurance. When you purchase a medical cover, and you become ill, you are admitted in the hospital, and maybe you're there for 3 days, your bill is 300,000, 400,000, you know, and maybe for that cover, you paid, give or take, 40,000 annual premiums. So insurance will actually encourage savings by reducing your expenses in the long run, because if you did not have that medical cover, you'd actually have had to dip into your pocket and cough out the 400,000 in patient costs. At the same time, insurance helps you reduce your tax burden. For people with like an education plan or life insurance, you know, it could be a savings plan also. You get a tax relief of 15%. So at the end of the day, if you have an insurance product, a life insurance product, it actually helps you reduce your tax burden. And this is something that excites a lot of my clients when we onboard, and immediately the policy is issued, you'll always find them in Charlene, send me tax relief certificates they can take maybe to their HR, or when they're filing for their, you know, when they're doing their tax filings at the end of the year, you know, in June, they can actually get that tax relief. So insurance is very important in that. And to end why insurance, my reasons of why you should take insurance, why you should have insurance in your portfolio is it helps you manage risks. Don't stay exposed. When you have an insurance product, it could be a personal accident cover, you know, it helps you manage your risks in that should that risk or that unforeseen event happen, you are protected. You have a plan as to how you will actually go about it. So that is my case. That is the case that I have put forward for why we should have insurance in our financial plan. So when we are sitting down and saying, I want to allocate X amount of money, say to an investment in treasury bonds, I want to build an emergency fund through a money market fund, I also want you to also sit down and say, I want to secure my future. I want to protect my family. You know, you could be married, you have children, you have a spouse. I want to secure my family so that should I not be there tomorrow, you know, I know that they will live relatively, could maintain their lifestyle, you know, because, and I always ask my clients to ask themselves, if you were not there tomorrow, will your family, their lifestyle either go down, become worse than it is right now, or will it remain relatively, or will it be better? So that is a question I want you to ponder upon. And with a good agent, you will be able to sit down, you know, with a good financial advisor. When you're doing your financial plan, you'll be able to sit down, do your investment portfolio, and do a protection portfolio. So today I want us now to discuss something that's very important, something that I always work with my clients, ensuring the different stages of your life. Yes, in different phases of your life. So when we are young and single, you know, no much responsibilities, you're just full of life, probably doing a lot of bucket list adventures, traveling the world. At this point, what insurance product you pick up? If you're traveling, get a travel insurance and see the world with your vacation or with your trip having been protected. And I'll tell you one thing. I'll encourage you after this, to me, if you're traveling, Let me get you a quote for travel insurance, and let me surprise you at how little the premiums for these covers are. You know, and with very little premium, you get, should you go and there's an emergency, you know, you get a medical emergency, or you need a medical evacuation, you are sorted. Should you go there and your passport is lost, you're sorted. Delays, you know, airport probably delays, sorted. So why leave, you know, for as little as just a few, maybe 15,000, 20,000, take the risk of going abroad when you do not have travel insurance. So if you are at this stage of life, you're young, you're single, you're exploring the world, take a travel insurance. Number 2, protect your personal accident insurance. This will help to cover for any injuries or disabilities. And a PA, I can tell you, a PA for one of the most reputable insurance brands in the market, for 250,000 coverage per year, you pay 1,182. And I want that to simmer in. 1,282. So for that PA, you're probably paying 100 shillings per month. So why wouldn't you take a PA? You know, sit down with your financial advisor, see how much coverage you need for your accident, and take up a personal accident cover. Number 3, you could maybe just have started working. You're thinking maybe in 4 years, you get back and do your master's, or you want to go back to your PhD. Don't wait till those 4 years are here. Take up an education policy. We have policies that whose term is 5 years. Others can even do a 6-year term, and it starts paying at year. You get? So sit down with your financial advisor and see, instead of 4 years and then running to the bank to start borrowing, start saving today. Start saving today, secure that goal, you know, with a guaranteed maturity that you will know that in 4 years' time, if I'm saving 5,000 every month, I know that my sum assured on year 4 will be X, year 5 will be X, and year 6 will be X. Or pick up a unit-linked product, you know, that you can actually access your money from the 3rd year, you know, and be disciplined and in every other month, you know, so that you actually get to meet those education goals that you may have. Lastly, protect your electronic and home appliance with home insurance, a domestic package. It's one of the cheapest insurance products you'll get in this market. And you see, when you're young and single, you really don't have much in your house, but you do have a laptop that you want to secure. You have your phone, you have maybe a seat, some electronics in the house, TV, your bed, your clothing, for ladies, our hair, you get? So take up a domestic package. And I challenge you again, reach out to me, let me surprise you by how little home insurance premiums are. You know, if your collective household goods, you know, are not more than $1 million, you can ensure that policy premium will not even be more than 10,000. And you actually get peace of mind that should your house be burglarized, should be walking down and your phone is not, you know, should you be headed home and your laptop is stolen, what you do is just run, go report at the police station, get your abstract, and submit a claim to the insurance company, and you're reimbursed. Basically, you're taken back to your previous financial position. So, young and single, you can see that is how I would encourage you to insure yourself. Next phase of life, married. Protect marriage. Number one, life insurance. Now, at this point, you finally have a beneficiary or dependent, your spouse. You're both dependent on each other. So protect your marriage with life insurance. It could be a savings plan. It could be whole life insurance. It could be term life. Right now in our market, we even have cancer covers. You know, protect your marriage with life insurance, number one. Then protect your marriage with health insurance. And the beauty with, and I want to mystify something about health insurance, because most of us think that we're talking of health insurance, it's only the premium covers that maybe will cost you, for the two of you, 80,000 towards 100, depending on the limits that you're taking. But did you know that we have county covers? You know, sort of like tier 2 insurance covers, where maybe someone who's 28, 30, for a limit of 500,000 inpatient and 30,000 outpatient, with about 21,000, you have that cover. So stop fearing. Get a financial advisor who can show you all these products, and a product that works for your pocket. So protect your marriage by getting health insurance. 3, get credit life insurance when purchasing a home by a mortgage. And this is mainly done through the banks. Yes, you find that banks no longer give out mortgages without actually adding insurance to that mortgage. Number 4, have your domestic package, your home insurance, and protect your home. Even if you do not have your home yet, you're still renting, the contents of your home. You know, as we said, your laptops, your phone, your seats, you know, your electronics, your kitchen appliances. Protect everything. Domestic package covers literally everything. You list everything in your house, get a quote. It's a very friendly product. Protect your home through domestic package. Because at this point, when you're married, you're creating wealth for the long term. Next phase of life, when you're married with children, ensure that you protect your family with life insurance. And now children are in the picture. Do your education planning through education policies, okay? And when we talk about an education plan, it should be specific to your child. You know, how old is your child? When would you like the annual bonuses to start rolling in? And one thing I always say, if you have not done this, maybe your baby is already 4 or 10, it's not too late. There is still a product, you know, for your child. And the beauty with education planning is this. Instead of waiting until your child is in secondary school and having to really struggle to raise the funds for school fee, why don't you start putting aside something small? Education plans start from as low as 1,500 shillings. So they can accommodate your pocket. It's for you to sit with your financial advisor, because also at the end of the day, insurance is not supposed to overburden you. No, it gets to a point that you cannot even take your family for an outing. You know, you can go on holiday because you're overly committed. No. So you sit down with your agent and then you plan. You see, I could start putting aside, say, 5,000, or I can put aside 10,000, or I can put aside 30,000. We have people who do 100, 200. So it really depends on your pocket size, you know, and it's very important, because with an education policy, that dream you have, if you've decided that you want your child to study at Kianda school, you know, start putting aside that 5,000 right now, so that when that time comes, you will not have to take bad debt, so that your child can go to school. Protect your family. If you're married with children, protect your family with health insurance. We've already touched on that. So do not shy away. Don't shy away, because you may be feeling, no, maybe the quote I got last time was for a very premium. It was very expensive. I can't manage. There are county covers. At the same time, if you want that premium cover, we have what is called insurance premium financing, where a bank advances loan to you and pays the health insurance upfront for you. Let's say your premiums are 100K. So we approach Bank X and they pay upfront the 100,000 to company X that you've taken your health insurance. Then they allow you to pay them in at most 4 monthly installments. So there's always a way of working around this. You have insurance premium financing. Also, if you're married with children, ensure that you are doing your investments and retirement planning. And as I mentioned when we were starting, through my page, through my platform, Mama Bima Kenya, we are currently doing retirement planning, a 4-part series. 2 years ago, we handled the individual pension plan, and this coming Monday, 4:30 p.m., we will be defining annuities. So this is very key. Start your retirement planning early. Don't wait until you're 55 and then now you go into a panic, wondering, how can I build my pension? Start early. Start putting something aside. So at the point of retirement, then at that point you could purchase annuity or purchase an income drawdown or part of the pension benefits, put them in an infrastructure bond and just be earning passive income through your coupon payments. So make sure that if you're married with children, you start retirement planning. Different phase of life. If you're a business owner, you need to protect your business. And depending on the nature of your business, there are several options that you may consider. Get your PI cover, professional indemnity. It could be goods in transit. Is it, do you need money insurance, theft insurance, fire and perils? So depending on your business, the nature of your business, sit with your FA and see what are the covers that are key for my business. And if in your business you have employees, consider having insurances. We're talking of health, maybe a group personal accident, WIBA, life, pension. You know, these are also key insurance products that you can consider if you are a business owner. Another phase of life, you could be employed. So if you're employed, maybe you could be in a reputable brand, then first look at what is the insurance coverage that I have with my employer? It could be maybe group life, or group personal accident. Then sit with your financial advisor and fill the gaps, of the insurance that you actually require. You could be working for an employer who provides you with health insurance, but you do not have life insurance and you do not have pension. In that case, sit with your financial advisor and open an individual pension plan. Take up a life insurance to protect your family. Therefore, if you're employed, it's your responsibility, to plan for your retirement, to protect your life, protect your dependents at home. And what I call like the next phase of life, retirement. Planning for retirement is critical, and this should start as early as possible. I get very happy when we start retirement planning for people in their 20s, because this tells me they are aware, they are intentional. Because you can imagine if you start in your 20s, and some of my clients are employed, you know, they have pension at work, but they still see the need, you know, the need to take up an individual pension plan so that they can actually boost, you know, their retirement benefits. I really hope that we are the last generation that will be depending, you know, for us, we would depend on our children as our retirement plan. And the best way of ensuring that that does not happen is to plan ourselves ahead. Let's plan for our retirement. So at the point where you hit 60, or if you do an early retirement at age 50, then from what you have saved in your pension or in your provident fund, then now you can purchase an annuity, you know, or you can purchase an income down. And you see, for products like annuities, when you purchase an annuity from an insurance company, you could even do it as a joint annuity, where you also cover your spouse, and you are covered for as long as you live. Like, guys, think about that. You know, when you purchase an annuity, you are sure that you will be getting a monthly income for as long as you live. And should you say pass away before your spouse, if you have a joint annuity, he'll be covered for as long as he lives. So that kind of security, you actually get it in insurance. Where else? Who else would guarantee you, you know, a monthly income for as long as you live? Okay, so make sure you do your retirement planning early, start early, build it. Don't just be at the mercy of your employer, where, you know, maybe every month my contribution and my employer's contribution is 10,000. Ask yourself, if I save 10,000 from now until say I'm 60, if all things remain constant, will that money be enough to take care of me maybe for another 20, 30 years in my old age? So, and if the answer, if you start having doubt, please sit down with our financial advisor, sit down, project, you know, do a projection, see the number of years remaining before you hit retirement, approximately how much will be your pension kitty in your occupational scheme. Then see how you can complement that by having a side individual pension plan. So from today's session, one of the goals I want you to have is insurance is not investments. We cannot compare insurance products with investments. And this is, I come across some clients when we are doing especially education planning, or if they want to take up an endowment plan for savings purposes, and they sit down and they're like, Charlene, if I will have contributed X and my tax relief will be X and my final payout is X, how much return is that? You know, so they're actually talking of percentages, like what interest rate is that? Insurance is not investment. Yes, for investments, let's be very prudent. Let's know X amount. I'm targeting at the very least maybe 9% return annually, etc. But when it comes to insurance, please see the bigger picture. Insurance primarily is for protection. Insurance is for protection. Insurance will keep you committed in your financial journey. Because, and remember, this is a long-term commitment, okay? So also make sure you discuss thoroughly, you know, with your financial advisor before you take up whichever product you're about to take up, so that you get to understand what are the non-forfeiture clauses, but if all remains constant, you know, be committed. It really helps you with your savings. You know, it helps you hit those goals. Remember, most of the insurance products, especially in life insurance, now endowment plans, these are illiquid. Yes, they could become liquid if, say, you do a cash surrender, but that is not the purpose why we actually take up these products. If you take up, say, a 12-year product, the goal is to go up to those 12 years and get your lump sum. You get it. But should the worst happen in between now and 12 years, your dependents, your beneficiaries will be taken care of, because the insurance company will actually honor contracts, you know, they sign with you. If you're paying 10,000 shillings per month, you get a tax relief of 15%. So that's as if you're doing 8,500 in 12 years, maybe we'll get, just this is top of my head, 2.1 million shillings. So should you, say, pass away in year 5, year 6, that insurance company will still honor that contract. And that is something always that always excites me, maybe, about the insurance industry, because insurance literally works with money that is not there. You can imagine doing premiums for 5 years, you know, like 5 years you've paid your premiums. It was a 12-year plan, and the insurance company still honors the sum assured at 100% should you pass away, you know. And it's not always about death. You see, with the life insurance products we have in the market now, you can cover yourself against critical illnesses. We are talking of cancer, you know, heart attack, paraplegia, kidney failure, and so on. So it's not just about death, it could be critical illnesses. And critical illnesses are, they are on a rise. You know, when you talk of cancer cases, when you look around your friends, family, you definitely know someone's been affected by it. So it's a reality. You are also covered from, in the event of incapacitation or disability. So remember, our key take home is insurance is primarily for protection. So insurance and investments, we cannot compare those two, but they complement each other. Make sure you have an insurance portfolio and an investment portfolio in your financial plan. Another take home, add an insurance, that I just mentioned, add an insurance or protection portfolio to your personal financial plan. So if before you were just doing money markets, you have over $1 million shillings, you do a wealth management plan, you have 50,000, you purchase a treasury bond. If that is all that's been in your financial plan, now start picking up insurance products, a protection portfolio. Another take home, get yourself a financial advisor whom you can trust. And I cannot overemphasize this. It is key to have a financial advisor, number one, who will look out for your interests. With a good financial advisor will save you money, number one. Because say you come to your financial advisor, you want to insure your vehicle. It's the value is 800,000 shillings. So your FA will be able to scan the insurance market and tell you, for this vehicle, 800,000, probably year of manufacture 2013, so 7 years. We are best placed with company X, because company X will give us a flat rate of comprehensive cover at 3.75, and we add an excess protector at 0.25. So all in all, 4%. So a different client comes, my vehicle is worth 3 million shillings, 2015 year of manufacture. So we go to a different company, because with a vehicle that's 5 years, over 2 million shillings, I know a reputable brand that will give this client now this vehicle comprehensive rate at 3.25%. So with a good insurance agent, a good financial advisor, they will be able to scan the market and respond to that specific need. So they're not just pushing a brand to you, it's actually your need that makes them now source for the best insurance product for you. And saving you money. Your financial advisor or your insurance agent will be your encyclopedia. They will save you time. You know, you need health insurance. Today I've told you that we have county cover. Excited, you can within your budget. You do not have to keep running to company A and B and C, because with a proper financial advisor, they'll sit down and tell you county covers offered by company X, Y, Z. You get? And out of these three, these are the quotes. This is the quote: 500,000 inpatient, 30,000 outpatient, and these are the hospitals in their panel, their list. So a good financial advisor will save you time. You don't have to keep calling in contact centers, trying to peruse through brochures. A good financial advisor will actually do that for you. So your take home for today: get somebody who can hold you in this financial planning and insurance journey. And the beauty with it, the service you get from your FA, in most cases, this is not charged. It's at zero bob. For me, in my case, Mama Bima, you see, I don't charge you, you know, for scouting for you, say a WIBA, you want WIBA for your employees and group personal accident, you know, I have my list of the maybe companies when it comes to that side of generally. So I will request for all the quotes, share with you, then we see which one works best for you, which one is the more pocket friendly. And I charge you, because once you give me that business, once it comes through my agency or it comes through my debit, I earn a commission. So from today, please utilize the services of a financial advisor who you can trust. Next, as we have seen, we have looked at the different stages of life. Review your needs with a financial advisor and ensure you're amply covered. Okay. Sit down, look, my family is growing, got married 2 years ago, now a baby is checked in. Sit down with a financial advisor and see, this is my financial plan, these are the investments I'm making, this is my disposable income, see what products maybe can I pick to secure my family's future. What products can I take to so that I save in advance, you know, so that I protect myself from taking bad debts, you know, 5 years down the line, 10 years down the line. So ensure that you are actually insuring different stages of life and then move from one stage to another. Make a point of reviewing your insurance needs and picking up the products that work for that phase of life. And yes, that's it. That's all I had for you today. And now I would want to open the session to a Q&A.
All right. Thank you so much, Charlene, for that informative session. Let me start with a question from Michelle. She says, if you have your side retirement plan and you're employed, will your employer contribute to that one, or is it your personal obligation? That's okay. On retirement. I have one on. I think you can take that one first.
Yes. Thank you, Michelle, for joining us, and thank you for your question. That's a good question. So, first question I actually want to pose to you: do you have an occupational scheme at work? Like, do you have a staff retirement benefit scheme? So, if your employer is already contributing into that scheme, then your IPP, they won't be contributing into your IPP. An individual pension, let me just get into it a little bit. An individual pension plan is a very good accumulation account for your retirement that you open for yourself, okay? So this is something, even from the name you can hear, it's an individual retirement plan. I have a client whose employer actually contributes into that plan. Reason being, she's employed, she's a sole employee based in Kenya, and the mother company domiciled in South Africa. So now what happens is the employer asked her to actually just open an IPP in Kenya, and they their pension contribution directly. So if that's, you could have such an arrangement with your employer. That is if you do not have a pension plan at work, and if they are actually willing to give that pension benefit. But if you have a pension plan at work, continue contributing, continue doing your employee contribution, and let the employer either match or do their bit there. At the same time, if you feel, if you actually sit down and see this will not be sufficient, by the time I hit, then sit down with an FA. Let's draw up a plan on how you can be contributing every month. And the beauty with an IPP, you do not get penalized. It accommodates your pocket, So in months that you are unable to contribute, you're not penalized for not contributing. And an individual pension plan is also very important when you're moving from one employer to another. Say you work for company X and you get a new job in company Y. Instead of leaving your pension benefits behind with company X, whenever you move employment, you now withdraw your pension benefit and transfer them to your individual pension plan. Okay, so all in all, it gives you, puts you on the driver's seat. You're more in control of your retirement. You're able to see your statement, see growth, rate of return, etc. And at the same time, you become very intentional when it comes to retirement planning. So yeah, I would advise Michelle, consider having an individual pension plan, run it currently with your occupational pension if you have one.
All right.
That's it, Rose.
Yes, as well on the pension, I think you had mentioned. I think the maximum tax-free contributions is about 240,000 per year. That's about 20,000 per month. So yes, if your contribution is below 20,000, you're still tax-free. So you can contribute as much. Take advantage of the employer contribution and continue contributing on your own as well. Yeah.
Yes.
Yes.
Thank you.
I know we shall be preempting the discussion that you shall have on Monday, but I would want you to somehow talk about annuities and income drawdowns. Just a little bit. Yes.
Okay, Rose. Thank you for that. So far, when you're working, you had your pension at work, or you were running your individual pension plan on the side. So when you retire, you could either do an early retirement at 50. So at 50, that means you can actually access your pension benefits. Or you wait until 60, which is the normal average retirement age. Some people even wait it out to 65, because at 65 years, then your pension or your retirement benefits become 100% exempt. So at the point of retiring, you were used to a system where you had an income every month. Now, once you retire, your income, basically you have no more income. Maybe you could do a business here and there, but pretty much you do not have that income that you were used to coming as a salary. So you have two options. Your retirement benefits were in what we call a pension plan. Okay, you can access a third of your retirement benefits as a lump sum, and 2/3 would have, this is actually mandatory, this is per law, 2/3 would then go into either an annuity or an income drawdown. Okay, so I'll now touch on what an annuity is or what an IBD is. But before I go into that, if your retirement benefits were in what we call a provident fund, you have the option of actually accessing 100% of your retirement benefits as a lump sum, which is not very advisable. A report by IRA, so that for the people who access their retirement benefits as a lump sum, retirement, they deplete their pension savings, those retirement benefits, they deplete them within 3 years of retirement. So you see, it can be very catastrophic, right? That you retire at 60, by 63, you have actually taken up, you have used up all your retirement benefits. So that is why annuities and income drawdowns exist. So, but as I was saying, with a provident fund, you have the option of actually accessing 100% of your retirement benefits, or opting and saying, I can just buy an annuity with X amount of my retirement benefits. So let's first tackle an annuity. Basically, an annuity is a contract that you get into with an insurance company that guarantees you a salary for the rest of your life. Let's say you're 60, your pension benefits are, say, 10 million shillings. So you purchase an annuity with that 10 million shillings, and even if you live to 100 years old, okay, the insurance company will be paying a monthly salary. Okay, so annuity is it's one of the best, surest ways of doing your retirement planning. That is now post-retirement. And basically, with an annuity, the insurance company will sit down, do the calculations. Most times, calculations are based on your age, because I mean, if early retirement, say at 50, and someone else purchasing an annuity at 60, you see the one at 60 will have a higher, if it's the same value, amount of money, okay? The one at 60 will have a higher monthly income, because I mean, annuities are also, they factor in life expectancy, yes, life expectancy, okay? So with annuity, they look at the sex, is it female, is it a male? They look at your age. They'll also look at the amount that you are purchasing, so with 100 million or 10 million or 600,000, because we do have companies where an annuity could start from 600,000, and they calculate for you and tell you that on a monthly basis, we shall be paying you, say, 73,000 shillings. Okay, so with your 8 million, we will be giving you 73,000 shillings, and this is for as long as you live. Annuities also allow you to have like guaranteed period you covered. This is very important, especially if you have beneficiaries, and you can be covered, say, from 5 years, 10, 15, 20. Some companies only go up to 20 years coverage. And this means, as an annuitant, should you purchase an annuity, say you're 60, you purchase an annuity, but you pass away a year later, okay? You pass away 1 year later. If you had taken a guaranteed period of 20 years, your beneficiaries will be getting this monthly income for the remaining 19 years. Okay, so it's important. I always encourage my clients, especially if they have beneficiaries, to have at least that guaranteed period, because it ensures, should you pass away, the beneficiary is still covered. You can also do what we call joint annuity with your spouse, meaning that should you pass away, okay? If you had a joint annuity, say pass away 10 years later at age 20 and your spouse is still living, then you insure them against risks of having financial constraints in that, because even after the main annuitant passes away, the joint annuitant, the spouse, will be taken care of by the insurance company. Just 1 minute, I need to get my charger. So the insurance company will still honor the contract they got into with the annuitant. So they will continue to send a monthly income to the spouse as long as the spouse is living. So annuities are very important. And when we are doing financial planning for my clients who are now retiring, I always advise pick up a product like an annuity, because it will protect you. It will give you that security. You will sleep with peace of mind. You will know that next month on 2nd, my EFT, I'm expecting my EFT in my account. I'm expecting X amount of money, which now will be like a salary. I think that covers the gist of annuities. Income drawdowns. Yes, Rose?
No.
Is that
okay.
something you'd want to add, please?
No.
Fantastic. Okay. When it comes to income drawdowns, now for income drawdowns, it is that you bring X amount to the insurance company, say 10 million shillings, and they calculate you. An income drawdown could be at a minimum of 10 years, okay? Minimum of 10 years, and they calculate for you and tell you, we shall be paying you X amount of monthly income, okay? So now with the income downs, the difference is, with income, you can access up to 15% of your of the per year. So let's say have 10 million shillings. You can access up to 1.5 million in any given year. However, income drawdowns are very dependent on the performance of how the insurance company is investing those funds. And that is, so as a client, you are actually taking up a risk. There's no more guarantee. It's not like with the annuities where you're guaranteed as long as you live, we are sorting you. With income drawdowns, there's that aspect of risk because it's pegged on the performance of the fund. Now, if say you take maximum, if you're withdrawing, you're drawing the maximum amount, 1.5 million, which is 15% of the fund. It means that should these funds not give a return more than 15% return, then you're actually eating into your principal. You follow? So let's say the return for the year is 10%, right? And you already drew down 15%. That tells you you've already eaten 5% into your principal of 10 million. So with income drawdown, it's sort of how can I say, there's a risk element involved, but I still come across clients who are they do not want to commit all this money insurance company and leave them to do whatever they wish. They do not want the guarantee that comes with annuities. Some are willing to take up the risk and say, maybe my fund is very sizable. Maybe I'll only be drawing just 5%. You get annually, I'll just be doing 5%. And you see now, the beauty with income drawdown is at the end of the term, should it be say a 10-year term, then you get back your principal, or you get back whatever is remaining of your principal. Then you can decide to either now purchase another income drawdown. Okay, sort of like rollover. Purchase another income drawdown. So you find their clients, they will do their math, see my pension benefits are really sizable. Okay, so I want to sort of like I do not want to give out that principal. So I'll take the risk, maybe just do a drawdown of 7%, annually. And at that point, for a smart client, then we will sit down, see which are the best performing companies now, and the stable ones, a good brand, but also one that is performing well in the market, so that you ensure that whatever you're drawing down does not touch, is not above the rate of return that the insurance company or the manager is actually giving you. So yes, that's it. Rose?
All right. Thank you
like
so
to
much.
add on IDDs?
Not for now. I think what we shall do, yes. I think we shall co-host probably the event with you on Monday. The training.
Fantastic.
Yes. So that we can talk more on that.
Yes. And as I mentioned, it's a 4-part series. So this month we really go into detail on annuities. Then in 2 weeks' time, we'll do a full session on income drawdowns. Okay. Then the last session, we will we'll be dealing with a strategy called ABCD, strategy of retirement, just seeing, in the different phases of our lives, like what kind of retirement strategy should you be having? What should be in your portfolio? Because you see, for retirement, when you're doing your retirement planning, it's not just about the individual pension plan. You need to be talking of your property portfolio, especially when you're much younger, up a piece of land here, ensuring you get home. Because now, by getting a home, that already secures your retirement. We need to talk about having an equities portfolio when you still can absorb that risk of investing in shares. Then, but we will move through the different phases of to see when we are aggressive, to moving to having a balanced approach, then eventually becoming conservative.
All right.
Yes.
Okay. Does Places provide linkage to IPF?
Okay. Thank you, Rose. Whose question is that?
He's called Monene.
Okay. Thank you, Monene. And yes, as I told you, we are very committed in working with the client in the insurance journey, in the investment journey. So yes, if my client needs an insurance premium financing, I will, by the time I'm onboarding you, as sign, say, the health insurance forms, I'll also come with the IPF forms. I'll ensure that I help you with the entire process. For you, it's just the instructions the bank will send to you, like transfer X amount here, issue maybe 3 or 4 checks. You get, but I get to guide you on which are the banks that Zile hazisumbui. Different providers have different service levels. So yes, I work with you through that journey. So yes, we help you with IPF.
Okay. For those who don't understand what IPF is insurance premium financing. So if your insurance cover is about, correct me if I'm wrong, Charlene.
Yes, first.
If your insurance cover is about maybe you've taken a car that the insurance is about 350,000 on an yearly basis, and you don't have the cash at that point. So what you do is, I think you pay a certain amount, and then you pay the rest to the insurance agents on a monthly basis, but they cover the whole amount.
But IPF, we mainly use it in medical insurance, but I'll tell you, like for motor, most insurance companies have become very flexible, and that's true, Rose. We do come across clients, your premiums are 350,000. Who has 350,000 to just, channel, remove from the pocket? Like, so you find that most companies give you you can in installments. Okay, the first installment is usually 40% of the premium, and the remaining 30% and 30%. And in various cases, like during this pandemic season, we are even able to negotiate for our clients for up to 4 or 5 installments. Okay, so if you have a good agent, they really do this for you. You talk to your agent, you tell them, like, one of my clients has picked up a general cartage cover. Okay, and when we started, we were good to go with the 30-30-30. The first time he actually did the 40% of the cover, but by month 2, when we were asking for the 1 month extension cover, he could not do the 20. I think it was 22,000 that he was supposed to pay for the second installment. And basically, I spoke, with our provider, and they were like, yes, we can advance 1 or 2 extra installments, and we are so tunalipa tu pole pole. So yes, for motor, there is a payment, and talk to your pay. Feel free to also reach out to Mama Bima. I will show you, any reprieve that you can get as a client. That is actually what we are here for. We want to ensure that you're not overburdened, also by insurance. I mentioned that when I was doing the presentation. Insurance is not supposed to overburden you as a client. That maybe you're going without food or fuel or what. Yes, so we look for ways to ensure that we are accommodating.
Okay.
Yes.
And on top of that, now you can use maybe a money market fund, probably to just save up for your insurance payments. Yeah.
Yes.
I don't know whether there's anyone else with a question. I would want to ask on my side about the home. Is it a home protection cover?
Yes.
Domestic cover.
Yes.
Yeah. What's the minimum amount that someone can pay?
Okay. Most cases for a domestic cover, they mainly start from 4,000. Okay. Yes. But the thing with a domestic cover is you do a list of your household items. Either if the home is yours, you also factor in, the value of the building. If it's an apartment, you don't write the value of the building. So you just you list down the contents, that you would want covered, and it's always advisable. Please do not just pick the all risk items. I come across clients maybe who they feel, where am I insuring my seat? Where am I insuring clothes? You get no. Just list down everything. Let me surprise you by the quotation that I share with you. Home insurance is not costly at all, but it really gives you that peace of mind that even if you travel out of town, or if you're not in the house during the day, should you come and find X happened, or maybe the building caught fire, there will be that reprieve where you'll be knowing that once I file my claim, once I get my abstract and I file my claim, return to the original financial position. Yes.
All right. Yeah. I'm actually surprised you can even insure hair.
You can. Hey, you see, Rose, we have people with hair, 40,000, 50, 60,000. So yes, you can insure your hair.
All right. There's a question: if you take a home insurance for the building and the house gets burnt and your car was there, will it be covered?
Do you mean the car? Will the car be covered?
Yes, I think that's the question.
Okay.
Yeah.
So now, home insurance. Remember, when we are when you're doing your home insurance, you will list down the building, the value of the building. You will also list down your house contents. The car is not there amongst the household contents. So if you're home insurance, also ensure that you have at least, motor vehicle insurance, okay? Comprehensive cover, or at the very, or do a third party that has fire effect, If you cannot do the comprehensive motor vehicle, then at least make sure that your third party has fire and theft. But yes, if your vehicle only has third party cover, the just general basic one, no, the vehicle will not be covered.
Okay. Carol, I hope you have been answered. On the car, please explain why most insurance companies don't cover the windscreen.
Most insurance companies don't cover the windscreen. Yes, I think you're insuring with the wrong companies.
Okay.
And you see, Rose, I think it's a matter of when we are taking our insurance, we do it very abruptly, and that's why I was emphasizing, get a good agent who, even when you have chalky to explain to you, what does this insurance cover entail? Okay. For example, did you know that anytime you do your motor vehicle insurance, you as the driver and your immediate family are not covered in the event of an accident, even if it's a comprehensive cover? Yes. And so with a good agent, anytime you're taking up motor vehicle insurance, they will actually ask you, would you like to do a personal accident cover? And we said personal accident, very low rates, from 1,282 shillings, 1,282. So each month you're doing 100 shillings. You have ample coverage. So get yourself a good agent. The windscreen should be covered. It's one of the most basic coverage when it comes to motor vehicle.
Yes.
Some cases you find for some vehicles, Like the basic amount that a windscreen is covered is usually 30,000. Okay. And you come across a vehicle maybe whose windscreen 100K, 120, you know, and so on, like high-end vehicles. So in that case, you need a financial advisor who's able to scrutinize once the valuation report is sent. He's able to scrutinize and see windscreen is valued at this. So the agent will advise you that we need to add X amount on top to ensure that your windscreen is totally covered, so that you don't have a 30,000 windscreen cover, yet your vehicle's windscreen is 100,000.
Okay.
Yes.
All right. Yes. And I don't think there's any more question. For me, I have been answered.
Yes.
Carol, I hope you've been answered. Monene, Michelle, Kevin, I hope you've been answered. I think what you can do is we shall share the link on the training on Monday from your site.
Yes. Thank you.
To the people who have joined in on this one, and also on our Facebook page, so that people can join.
Yes, thank you.
Yes, I think we've come to the end of this session. For anybody who would like Mama Bima's contact, they're there, right there on the screen. The telephone number is 0739 040 400. On Facebook, it's Mama Bima KE. On Insta is Mama Bima Kenya. Yes.
And my email address?
And your email address, yes?
Is mamabima@places.co.ke.
mamabima@places.co.ke. Yes, I have shared it with everyone.
Fantastic.
All right.
I'm very grateful for the opportunity to just talk about matters insurance and investments. I'd like to engage you guys more, so please reach out. Let's talk. Let's learn. Just like Rose and the Vasili team are doing, I am very passionate about just hand-holding, you know, clients or just people, letting you know this is where there are opportunities here for you, you know, with your pockets, you know. I feel that in our market, there's actually an investment opportunity for everyone, irrespective of the pocket size, you know. But money market fund, but I only have what, 3,000, and I tell you, yes, we have. You can start from as low as maybe some funds 100 shillings. Yes, others 1,000 shillings. You know, others 5,000. So there is actually room for each and every one of us. Just get an agent, get someone whom you can trust to walk this journey with you. I'm very grateful, Rose, for the opportunity.
No, asante sana for agreeing to be with us. I hope it's a start of a great partnership between us and Places.
Yes, lovely. Yes, I believe so. Yes.
Asante sana.
Thank you.
I think we can leave the meeting and then we will be starting again next week, maybe from 10 a.m. sorry, with a new topic. But we shall be on Facebook Live on Monday with Mama Bima. Yes, to talk about annuities.
Yeah.
All right.
Thank you very much, Rose.
Asanteni sana. Thank you and have a lovely day.